What's going on, guys, and welcome to another video by LD the Trader. Today we are going through the difference between a breaker block and a mitigation block. Now these two do get easily confused and I completely understand why, but today we're going to go through why these two price arrays are different. Okay, so let's jump straight into it. So the breaker block and the mitigation block, in my opinion, are relatively kind of the same. The only real difference between these two blocks is this. Bear with me. High, low, higher high, lower low, test, down. Okay? This would be the breaker. Make sure it's tagged in. So what would the mitigation be like? High, low, fail swing high, down, test, boom. This is the only difference between the breaker block and the mitigation block. The breaker block makes a higher high, whilst the mitigation block makes a failed swing high. Now, mitigation blocks are a lot more common within price action, as when price is on a downfall or an uptrend or whatever you want to call it, the retracements are classed as mitigation blocks because they're failed swing lows and failed swing highs. If you feel a little bit lost, don't worry, we're going to go through it in actual price in a second. So what actually is a breaker block? The breaker block is the lowest down close candle in the most recent swing low prior to the high being ran. That is a bearish example, vice versa for bullish. When it comes to the breaker, I got taught this by one of my mentors. Always think this. For a bearish example, high, low, higher high, lower low. Then that's a breaker. If you want a bullish example, we'll go low, high, lower low, higher high. There we go. Just like that. That would be a good bullish example. The definition for a mitigation block. A mitigation block is when price actions makes a swing high, then a retracement, then a failure swing high, respecting the current highs. We then want to see a swing low disrespecting the lows, causing a market structure shift. After this has happened, you want to highlight the lowest down close candle in the swing low, and this will be considered your entry point in the mitigation block. So, the first thing I see here. Let's jump straight into US 500. Okay. High, low. Failed swing high, lower low. So what would this be? What would this last down close candle be? Would it be a breaker or mitigation? If it's a mitigation, that will be correct. Well done. These up candles here, aka the retracement, are also classed as mitigation blocks. Why? Because these are failed swing highs. These candles here are attempted to break above this high, but have tremendously failed. Some class these as order blocks. You can class these as order blocks. At the same day, it still does the same job. It don't really matter. It's not that deep. So remember that saying I said for a bearish one? High, low, higher high, lower low, dun, dum. Where would the breaker block be? 3, 2, 1. Ta-da! That one right there. And just how I like it, in line with a fair value gap. Now, why do I like it in line with a fair value gap? Because you've got to think, price arrays are there to provide support and resistance, as well as drawing liquidity, but in this instance, it will be support and resistance. So, a breaker is a price array, so is a fair value gap. If you have two next to each other at the same price, at the same value, it's going to provide, like as you can imagine, an extra strong area of resistance. Do you know what I mean? So it's amazing when it lines up. It gives me so much more confidence with whatever trades I'm taking. And yeah, I do love the breaker block. So yeah, a very nice, simple and quick video today. I hope it makes sense for you guys. I hope you can now notice the difference between the mitigation and the breaker block. Till the next one, take care. Peace.